multifamily is changing because of the rapid compression in cap rates. The compression in cap rates since 2011, 2012 has been stunning, right? If you look at where US cap rates were in 2012 and where they are in 2020, it's stunning. As you know, things have gotten better than most people thought, including myself, through the pandemic. We haven't seen much of a increase in cap rates. We've seen, small increases in price here on this asset, and okay, this one sold for 10% less and that one sold for 5% less. But generally, when you look at the market, there hasn't been much of a change in cap rates so far. I think we're going to see a little bit of that going forward, but vaccines are here, so they bailed us out. So to me, when I'm looking at changes in the marketplace, I don't think that multifamily changes much. The value add world doesn't change much. We think that these lower interest rates have given us another boost so you can, make a value add business work for the next 2 or 3 years. But I think that this cycle ends because when I'm looking at what profits that investors have made over the last 3 years, 80-90% of it was cap rate compression. That concerns me because how can such a model be sustainable? If 80 to 90% of the money that investors are making is because of cap compression, which, I don't create cap compression. Duke doesn't do it. Vincent doesn't do it. The market does it. When the market stops doing cap compression, then you've lost 80% of your profits. Well, so it is not a sustainable business. So what I am seeing is I'm seeing syndicators start to pivot. They're making changes because they're realizing that their business model is not sustainable. They got another 2 years out of it because of COVID. But what happens in 2022 or 2023 when, cap compression stops or reverses? Then what do? Right? So people are looking at new business models. One thing that's interesting to me is I've been doing development projects for about 5 or 6 years. And this year I'm seeing in syndicators that I give passive money to. I have my favorite syndicators. I think I have 16, passive investments right now. So I give money to other people because, what do you do with the money that you make? You have to put it somewhere. And you can't constantly be putting all of it into your projects because it becomes, all eggs in one basket. So I invest in syndications, hotels, legal syndications, where you're giving money to lawyers to go, fight, class action lawsuits, all sorts of stuff. And one of the things that I've started seeing is in this year, more and more of my favorite syndicators are pivoting. Guess what they're pivoting to? They're doing new construction. Which, when you think about it, makes all the sense in the world. These are people that have done $1 billion of value add without ever doing one new construction project. And now they're doing a $50 million new construction project. So people see the writing on the wall. That's the trend that we're seeing in the marketplace. We're seeing new business classes emerge. One called build to rent is absolutely phenomenal, and more people should look at it. I think people don't understand, if I was able to get into a new asset class in its first 2 years, I would be made for life. Well, you have a new asset class. It's 2 years old. It's called build to rent. Look into it, right? And it's very deeply tied to multifamily because it is multifamily that is designed to rent, but they're single family homes or townhomes as opposed to apartments. I think apartments will do fine with new construction, but I think that going forward, COVID has changed the balance. People want more room. They want backyards. They want townhomes that have backyards in them. And so that kind of asset simply doesn't exist in the US, and more people are going to build it. And when we do boot camps, we're actually pivoting our boot camps to include some of this content in there. So no one in the US has ever taught a boot camp that's new construction. And we're now beginning to pivot and add content into for new construction into our boot camps because we're like, that's where the opportunity is, right? And our investors understand that. We raise $8 million a quarter in new development projects for investors. $8 million a quarter, $32 million a year. Why? Because the investors get it. Doesn't matter what the syndication industry thinks. We don't have the money. Investors have the money. When they change their mindset, we will change with that as well. So we're very laser focused on looking at understanding forward-looking trends. I just don't think that people do that because people are afraid to say that. Like, imagine this. I mean, I have $125 million of value add real estate, and here I am in a podcast bashing value. People are uncomfortable with it. Everyone should only do 506C. I think 506B deals are done by people who are afraid that they will not be able to fill them. If you do the math, you will find that 506C deals will fill up faster than 506B. The only time you should do a B deal is your first deal. Your second, and maybe you're second. But the third deal, if you're doing a 506B, you're taking a gun, shooting yourself in the foot, and then continuing to shoot other parts of your body. I think it makes sense to pivot or to add these kinds of elements, but you have to be careful about it. For example, I have been asked for the last 4 years why I don't do co-living, right? Why don't you have a co-living asset, Neil? It seems like your sort of thing. You're very, advanced. You're kind of cutting edge. People would, have heard about co-living. And the answer is everything has to be looked at in terms of research. When I researched, what I found was there was no evidence that co-living as a financial model was succeeding, right? The number of people that wanted to do it, it was such a niche that I didn't want to be in like a tiny, tiny niche. I mean, for example, build to rent is a phenomenal model. It's already succeeding. It's already, sub 4 cap. So I think, yes, have something that differentiates you, but make sure it actually is something that works, something that is beneficial, because otherwise it's just marketing nonsense. I was the real scenario was not as bad as I thought, as other people thought, because we forgot that you don't fight the Fed, right? One thing I've learned over and over again, and this is a lesson that I seem to forget every time I learn it, is that the US Federal Reserve is the most important agency in the world, not just the US, but in the world. I often say the president of the Fed is the real president of the United States, right? So, or the chairman of the Fed, because they have the control that they have over the economy, the level of skill that they have, because it's a truly data driven organization. I mean, I admire the Fed in terms of how data driven they are. I think the changes that the Fed made, the interest rate cuts, the aggressiveness with which they did it in mid-March, in the first month of the pandemic, was truly phenomenal. And so the impact that they had on the economy was outsized, was humongous. So even right now, where you have huge numbers of people laid off, you have the stock market doing well. Why is it doing well? Because of the changes that the Fed made. Because obviously, any benefit that we might have seen from the stimulus is long gone. That effect was gone by September. We're in December now. So obviously, why, if the economy continues to do well, it's because of what the Fed is doing. So the Fed's action was absolutely phenomenal, had enormous impact on the marketplace and prevented there being crashes in the marketplace. We've still seen some decline in multifamily pricing, but not of the sort that me and others, we thought of. So as far as I'm concerned, I believe that my COVID forecasts they were simply bearish. It was the people that were bullish that were right. I wasn't.